Interest rates, they've started to rise in Canada, but investors still are worried about a lot of press about the fact that as interest rates rise, bond fund values go down. On the other hand, fixed income is such a great harbor in this perpetual stock storm we're in. Today we have back David Feather, the President and Managing Director of Russell Investments Canada, to explain about Russell Canada's fixed income strategies. Welcome back, David.
Thank you, John. Good to be here.
Now, of course, one of your big suppliers is PIMCO, which is, of course, Bill Gross.
Yes.
For those who don't remember, tell us what the initials PIMCO stands for.
PIMCO is the Pacific Investment Management Company Limited, and they are an advisor to, I think, in all of Russell Canada's fixed income products. They would manage the whole product. They would manage a sleeve of it. So in our Core Plus, they manage about 1/3 of the product. In our Canadian fixed income product, they run a quarter of the fund. So if you're an investor in Russell in Canada, you're getting PIMCO in one form or another.
And PIMCO is almost the largest fixed income manager in the world, as far as
I believe they are the largest active fixed income manager in the world. And they've, as you know, a couple weeks ago they made a further reach into the equity business as well.
Yeah, which was interesting. Some people took that as a call, as a sort of like he's made sort of negative, like is it a bond bear? And let's either say that is there a bond bear market right now, just because interest rates are rising, or do you believe, as Vanguard's put out a couple of months ago, that people should just have a diversified fixed income portfolio, just as they would have a diversified stock portfolio?
Yeah, I don't think there's a real fear there of a bond bear market, John. I think what there is there's a muted view to sort of the depth of returns this decade in both fixed income and equity. And there is opportunity in both, but it's more selective. And if you look at where PIMCO is right now, their view, and certainly Russell's view as well, is that you are more likely to make gains in a strong equity strategy this decade than you are in a fixed income strategy. And that doesn't mean fixed income doesn't play an important role in a portfolio. And certainly, as you alluded to a minute ago, a diversified fixed income strategy is probably very prudent relative to just doing a basic vanilla laddered bond strategy. So by diversified, meaning hold some corporates, varying levels of quality within the corporates. We think just like on equity management, good managers can find great corporate bonds right now that have tremendous step up in yields, way beyond the comparable step up in risk. So a great bond portfolio should be looking at a strong mix of assets there. Emerging market debt is another interesting place for investors right now. And again, this isn't something people should go out and hold 40, 50, or 60% of their portfolio in. But to find a good manager, and PIMCO is a good one, that can mix this type of holding into a bond portfolio is tremendous, and get a more diversified bond exposure. It's a real dilemma for investors right now, because even a premium money market fund is paying nothing out in Canada. And the view is, and if you saw the inflation number that came out in the U.S. The other day was 0.9%. We don't believe there's a huge scare of inflation right now, but there likely is going to be an interest rate increase at some point in the next couple of years. And most likely, that'll obviously impair the return on bonds. But we think stocks will likely be able to get through that period. We don't think we have a cataclysmic event happening on capital markets. At the same time, there's going to be opportunity to make specific gains better than broad gains in the market. Okay, so I think that's some of the reasons PIMCO is reaching out. And I think my sense is they're looking even broader towards emerging markets than they are to markets in general on the equity side.
So presumably an investor who looks to a wrap account doesn't have to worry about these asset allocation decisions, whether how much stocks, how much bonds. In sovereign and some of your other products, what is the mix right now in a balanced portfolio?
I think that's right, John. We can certainly take some of that concern off the investor's hands between us and an investment advisor. It depends on the type of product and the investor in terms of what the mix is. We have a retirement essentials portfolio now that is 70% bonds and 30% equities, and that's largely geared to investors who are currently retired. We don't believe that investors, just because they're retired, should pull out of equities. A lot of their future income can still be generated in equities while they're retired. In sovereign, generally, it's very customizable. So an investor and an advisor can select the amount of fixed income weighting they'd like. But typically speaking, a 60% equity, 40% fixed income is a very common weighting that you see in a lot of those portfolios. And that we will help an investor make that allocation along with their advisor. But I do agree with your comment that if we can take that decision and make it a little more stress-free for the investor, it makes things a lot easier. And we certainly have a lot of analytical tools that can help them through that process.
Pretty ironic, the classic balanced fund mix of 60-40, the classic pension fund mix.
Yes.
So given your origins in the mutual fund industry, it sounds like everything is quite consistent.
And put some emerging markets in there too. I think that some of these things are interesting for investors and that they might not do on a standalone basis, but they're admirable asset classes for everybody to hold.
Great. Well, thank you very much. We've come to our end of our time. David Feather, I wish you luck in steering Russell Investments Canada into its near and longer term future.
Thanks very much, John. It's great to see you and great to be here.